Hello, I'm Gildas Quinquis, the Chief Investment Officer at Windrose Advisors. It's been about 3 months since our last letter, and I'm happy to bring you this update in May on the state of the markets. I think this is very topical, given all the upheaval in April. Obviously, we're very focused on potential recession signals and what could happen over the coming month. So some of the data that we'll be very cautiously watching is, first of all, unemployment and any signs of potential bond market dysfunctions. Those two metrics will condition potential intervention by the Fed to cut interest rates, which obviously would have a great impact on the market. The other signals that we're watching out for is any signs of slowdown in economic activity. None of this has shown up in hard data yet, so we're watching out for soft signals. Things like credit card receipts. Are consumers paying their credit cards balances in full? What is the status of container ships leaving China headed to the US? We're seeing a lot of softening in this type of signals that should be announcing potential weakness in the future. So when it comes to inflation, markets have already reacted to the tariff announcements. And what you're seeing is short-term inflation expectations moving up toward closer to 3%. On the other hand, longer-term inflation expectations are staying well anchored, little north of 2%. So what this is telling us is that investors anticipate a price shock that is probably temporary in nature as markets reset to new tariffs. Obviously, high inflation would be detrimental to fixed income securities. What that means to us is we're wary of long duration fixed income securities. We prefer short to intermediate duration to protect against that type of risk. So we're seeing divergences between public markets and private markets. And the main reason for that is distributions have dried up in private markets. You have had a non-functioning IPO market, and the market for mergers and acquisitions has dried up. Why? Because of all the current uncertainty in the market. What that means is that private markets have been frozen of late, and it's opening up interesting opportunities for investors that do have cash on hand to deploy into these markets. The cost of liquidity has gone up. It means that the reward for putting money to work in those markets will be greater in coming periods. So we think that the opportunity set is actually improving for new capital. Whereas for legacy investments in private markets, there will be pockets of pained potential markdowns. But the forward picture is actually looking more and more interesting. So the greatest adjustment we've seen in pricing is in venture. Those are longer dated portfolio companies that require a lot of years, a lot of time to grow and mature into a successful business. Investors are unwilling to commit their capital for extended period of times, given the lack of liquidity in this market. So we've seen a significant price adjustment. Venture capital secondaries trade at maybe a 30% discount today, which is indicative of the better pricing that new investors can get for fresh investments into that arena. The additional factors is the retreat by larger institutional investors into that sector of the market means that it's actually easier for firms like ours to get access to top flight managers. And our ability to remain persistent in allocating to this market will become a competitive advantage. Private credit is a very interesting asset class. Before I dive into the answer, let me just lay the context for this. Private credit consists of many different sub-strategies, but you can categorize them into two groups. One of them is income-oriented, The goal there is to generate monthly or quarterly income distributed to investors and strive to avoid any defaults. On the other hand, you can look at private credit as a substitute to equity-oriented strategies. And there the objective is to generate a total return that is a good risk-adjusted return. The objective is not necessarily to generate income, although that would be a byproduct of the asset class. And there, the return opportunity is greater. It's more complex. It requires careful active management, but it provides substantial benefits in terms of the performance across an economic cycle. Again, difference between the two, direct lending provides a high level of income, but is exposed to default risk in a recession. Opportunistic credit, on the other hand, provides a higher level of total return, meaning income plus fees and potential appreciation to warrant exposure, and provides the potential for enhanced returns in a recession through the ability to take advantage of potential market dislocations and acquire credit exposures at a discount. How has the environment evolved? Well, since the tariff announcements, the risk of recession has gone up significantly. We think that there will be significant pain incurred in the credit markets, particularly with private equity-sponsored smaller companies that took on floating rate loans in the 2020-21 period that have been successfully kicking the can down the road the past couple of years in order to avoid defaults, but are now facing pressures on the top line. So we think the risk of defaults will go higher and is going to make life difficult for the direct lenders participating in those strategies. You've already seen market participants start to short the stocks of asset management firms like Ares, Blue Owl, trying to stay ahead of this development in markets. So this is on the traditional direct lending side, which is, by the way, where most of the capital under the heading of private credit has gone over the past couple of years. The opportunity set, on the other hand, for opportunistic credit strategies is expanding because in an environment of rising defaults, it means improving prices and greater chances at accessing opportunities with equity-like returns in the future. So we're actually very excited about the potential environment for opportunistic credit in the coming period. So very well protected, but maintains the ability to flex into either stress credit situations, so a little more complexity, or potentially rotate into public market opportunities, which would prove to be maybe shorter term, high return capital, taking advantage of a market dislocation and cheap prices, before rotating back into the traditional bread and butter business of extending direct loans to companies. So that's a very interesting, flexible strategy that can adapt very well to this environment. So we recently partnered with one of the platforms to make one of our fund of funds available in the private credit asset class. We think it's actually a very unique offering for the IRA market because it's one of the few private credit fund of funds that I've seen. Most funds offered on platforms involve access to one firm, one fund. So it's a very concentrated exposure, and it requires extra diligence, especially in this environment. Why? Because I think that very helpful markets have muted differentiation between all the various firms, and we haven't seen who is taking more risk than the others yet. And so having a fund-of-fund approach allows you to diversify the risks. It allows you to tap into multiple complementary areas of the market, meaning not just corporate exposure, but maybe some asset-backed finance as well, again, in an effort to diversify the risks and the potential sources of return. So we think this is an area that traditionally IRAs have not accessed, and so that's particularly interesting for the clientele. Well, very interestingly, we've been educating our clients over the past 2 years for the potential volatility that we experienced this year. So I think our clients are very level-headed heading into this storm. We've been positioning portfolios ahead of potential volatility, as always, emphasizing cheaper areas in the market that are less subject to big downside adjustments, looking to protect portfolio principal and mainly focusing on capital preservation. This was a positioning that looked overly cautious last year, but came to bear fruit this year, where we are able to show clients a much more stable portfolio that is well positioned to handle potential stress. In today's market, there are actually a number of very interesting contrarian opportunities that present attractive valuations that I think will reward investors over the longer term. One of them, interestingly, is energy, which is certainly very much out of favor as everybody runs away from the risk of recession. But if you project yourself out a couple of years, energy demand remains very substantial, especially considering the demand on energy from artificial intelligence, at a time when we think supply is going to become very constrained, particularly in the US. Supply has been seen as plentiful, but we think that the main basins in the US, including in the Permian for oil and the Marcellus for natural gas, are both reaching peak conditions, meaning we won't be able to expand production much from here. So this is going to place very significant pressure on supply and will tend to boost the appeal of energy. In addition, all those shares are trading at very cheap levels today, so I think that presents an interesting value opportunity. The risks lurk in financial assets. I think investors are going to come to value real assets, hard industries in their portfolios as another way to build up resiliency. So that's a very interesting area. Another real asset opportunity involves investing in real estate. Now, real estate has become destroyed since the rise in interest rates. It's been a very difficult place to make money recently, but it means that actually valuations are quite interesting in a number of subsectors. And if you project yourself long term, the household formation in the US is very substantial with a new generation of millennials, and yet the supply of housing has been very constrained for a number of reasons. But we're finding ourselves in this supply and demand imbalance that's going to persist for years and provide support for real estate as an asset class. So I think now is a very interesting time to look for ways to participate in this. And we are looking to access it, interestingly, both from public equities, private equities, as well as private credit. So very interesting ways to seek exposure to what I think would be a very interesting downside protection type asset. Another area of interest to us, and we've been positioned that way for the past couple of years, is foreign equities. The US was the winning market up until now, and has drawn a lot of equity capital into our domestic market. This has led to significant undervaluations of foreign markets. So those shares look very attractive, especially compared to expensive US shares. They are now benefiting from a boost from rising currency appreciation. So, double tailwind for foreign equities. And some markets look particularly compelling. I'm thinking of Japan, which is also undergoing a period of transformation where companies are starting to become better steward of capital and return capital to shareholders. So we think there are a number of very interesting opportunities despite all the upheavals in markets today. So hedge funds as a group are actually a very interesting strategy. They tend to thrive in periods of rising volatility and rising dispersion. In particular, long-short equity, when you think of it, they are looking for best stocks to own long, and they're hedging that risk by looking at the worst stocks that you should want to short. So they're able to capture the spread between long and short in a rising dispersion environment. Rising volatility is another area that benefits active strategies generally, in particular hedge funds that make concentrated bets, because volatility means large downside, sometimes concentrated in stocks, sometimes happening to stocks that don't deserve to be punished. Sometimes being in just the wrong industry and yet being a good business model means that you find great valuation opportunities that active managers, in particular hedge funds, are very well equipped to capitalize on. So we think the coming period is actually becoming a very compelling time to consider hedge funds in your investment portfolio. So we're very cautious on areas of the market that we see as overpriced or very exposed to recession risk. And those two areas are either large cap growth stocks, mainly in the tech sector, that are now back to extreme valuations after having rebounded. So the risk there is a reversion to the mean, where valuations come down, potentially because those companies are not able to sustain the rapid pace of growth that they've seen over the past 2 years, or because investors take fright and leave the markets, selling index passive exposure where those stocks are overrepresented, so leading to a downdraft. The other area we're very cautious about is any sector that would be exposed to recession risk, obviously, and hence the rising risk of default. And there, when you consider US small caps, there's a cohort of smaller companies with bad balance sheets, weak business models with few earnings that are going to be very challenged. So those would be two areas we would avoid. I would differentiate on the small cap side between the high quality companies that we favor, that are actually trading at a discount, versus the lower quality companies that face this higher risk of default. Well, this is a very difficult environment because of all the uncertainty. And what that means is that investors are loath to commit their capital. So this is actually a time where investors that remain committed to the markets like us can benefit from enhanced access to managers. On the other hand, managers are very willing to incentivize those early movers like us by providing preferential terms to promote investment. So I can tell you that most of our recent allocations have involved some form of fee discount or preferential terms such as founder share classes. So I think this is a very interesting time where a firm like ours is able to capitalize on those trends because of our commitment to those strategies and because of the strength of our client base. So the message we have for our clients today is to maintain focus on capital preservation. This is going to be a difficult environment. And what that means is you want to look for areas of undervalued assets with good downside protection and avoid expensive part of the market that are exposed to this downside risk. In a nutshell, areas to emphasize would include strong balance sheets, so high quality assets, preferably with strong ability to distribute capital through income and dividends. In an environment of higher volatility and greater uncertainty, you want to diversify your portfolio as much as possible and look to acquire as many potential sources of return as you can possibly get, because we just don't know exactly how things are going to turn out. So that means leave no stone unturned, participate in private markets, participate in hedge fund strategies, look for pockets of opportunities in public markets, both in equities and fixed income, and at all costs, avoid areas of overvaluations. If we want to leave you with one message, it is don't buy the dip. In our view, this is a regime change. We don't know yet where the new protectionist regime is going to land, and we want to be careful about portfolios. But thank you for listening to this market update. If you have any questions or comments, please feel free to follow up with us. We're happy to answer any of your questions. Your business is very important to us.